Every single investor faces this classic tug of war. Do you go all in on chasing that explosive growth you see in tech stocks, hoping for those massive capital gains? Or do you play it a bit safer, prioritizing a steady, reliable stream of income, especially as you get closer to retirement? It's that age-old dilemma, growth versus income. But here's a thought. What if you didn't actually have to choose? What if there was a way to get a piece of that incredible tech-fueled growth and get a nice, fat monthly paycheck deposited into your account? Well, that's the exact problem a whole new breed of investment products is trying to solve right now. And that right there brings us to the main event today, the Covered Call ETF. Think of these as a hybrid solution, specifically designed to deliver both that capital appreciation and that high income. All right, let's stop talking theory and dive into a real-world example that's been making some serious waves. So, let me introduce you to the Goldman Sachs NASDAQ 100 Premium Income ETF. The ticker is GPIQ. Now, it's a pretty new player in this game, but its performance it's quickly made it a top contender for investors looking for that perfect blend of growth and income. And here it is. This is the headline number that's really turning heads. Since it launched, GPIQ has delivered a massive 53.44% total return. Now, just to be clear, that number is a combination of the fund's share price going up plus all the income it's paid out. So the big question is, how on earth did it pull that off? Well, a huge part of the answer is sitting right here in its portfolio. You see, GPIQ is heavily, and I mean heavily, concentrated in megacap tech stocks. In fact, as this chart shows, almost a third of the entire fund is invested in just 3 companies, NVIDIA, Apple, and Microsoft. That concentration has been an absolutely massive driver of its recent success. But look, just holding great stocks, that's only half the story. The real magic, the real innovation, is how GPIQ generates that high income on top of the growth. So what's the secret sauce? Well, it all comes down to a strategy called a covered call. Okay, let's break this down with a super simple analogy. Imagine you own a house, and that house represents the stock. Now, to make some extra cash, you decide to rent out a spare room. That rental income you collect every month, that's the premium. But there's a catch. In exchange for that rent, you agree that if someone comes along and offers you a specific, higher price for your entire house, you have to sell it. That is a covered call in a nutshell. You're collecting income now in exchange for capping some of your potential future profit. And this is where GPIQ's specific strategy really shines. Instead of writing calls on its entire portfolio all the time, which would cap all of its upside, it uses something called a dynamic override. This just means the fund managers can adjust how much of the portfolio they're renting out, anywhere from 25% to 75%, depending on what the market is doing. This flexibility is key because it means they can pull back during a big rally to capture more of the gains or sell more calls to generate more income when the market is just treading water. GPIQ also has a couple of other tricks up its sleeve. First, it uses something called flex options, which are basically just customizable option contracts. This gives the managers more precision to target specific prices and dates, which can help squeeze out a little extra income. And second, and this is a big one, its tax treatment can be way more efficient. Unlike some competitors where the income is taxed at your high ordinary income rate, GPIQ's structure means a big chunk of the gains, 60% of them, are taxed at the much lower long-term capital gains rate, and that can make a huge difference to what you actually take home. So we know how it works, we know what makes it tick, but how does it actually stack up against the other big players in the NASDAQ 100 covered call space? Okay, let's do a little head-to-head comparison. All right, looking at the numbers for this year so far, GPIQ is clearly leading the pack. Just look at that total return column. Its 10.25% return is more than double that of its main rival, JEPQ. Now, slide your eyes over to that last column. Its expense ratio of 0.29% is also lower than JEPQ's. We're focusing on total return as the main metric here, but getting higher performance for a lower cost, that's a pretty powerful combination. Okay, GPIQ looks really impressive. No doubt about it. But this brings us to a much bigger, more fundamental question for any investor, which is this. Does a complex, actively managed strategy like this actually beat a simple, dirt-cheap alternative in the long run? It's really easy to get laser-focused on fees, but it's worth taking a step back and considering another perspective. The investment research firm New Constructs argues that while fees are absolutely important, what's inside the ETF? The actual quality of the stocks it holds is the ultimate driver of performance. They actually suggest watching out for 3 big red flags: inadequate liquidity, which just means a fund is hard to buy and sell, high fees, of course, and most importantly, poor quality holdings. It's a great reminder to always, always look under the hood of whatever you're buying. So let's apply that thinking right now. On one side, we've got GPIQ, the contender, with its active, complex strategy and a 0.29% fee. On the other side, we have a true classic, a simple S&P 500 index fund like SPLG. It just passively owns the market, and it charges a minuscule 0.02%. The difference in both strategy and cost is, well, it's massive. And please, don't just brush off that tiny difference in fees. It might seem like nothing, but as one investor on Reddit pointed out, going from a 0.03% fee to 0.02% isn't just a tiny drop. It's a 33% reduction in your costs. Over an investment timeline of 30 or 40 years, that tiny difference can compound into tens of thousands of dollars. It really adds up. So, with all of this swirling around, how do you actually decide what's right for you? Well, it really just comes down to using a clear and simple decision framework. Here is a simple 4-step process you can use. First up, define your primary goal. Is it income right now, or is it maximum growth down the road? Second, really understand the fundamental trade-off of a covered call strategy. You are giving up some potential gains for that income. Third, compare the total costs, not just the expense ratio, but also taxes. And finally, always, always ask yourself if a simpler, cheaper alternative might just get the job done better over the long haul. Ultimately, it all boils down to this one question. There is no single right answer here, and there's definitely no magic formula. The only perfect strategy is the one that fits your personal financial journey.